Coming up today, the market hits a new all-time high as investors celebrate a loose Fed. Yellen says policy is still restrictive. Are we going to get a repeat of the 90s? Why Tesla is soaring? Is the Bank of Japan about to do a rug pull? And is this a fake out, or did J Powell just cause markets to go into melt-up mode? It's another big day, guys. Let's go. And thank you once again, Papa Powell, for all the green in our portfolios today, as he tells us all once again, F your puts. No way he's going to let this market crash before November, right? All-time highs, S&P 500, 57.13, with the market pretty much playing out like a textbook after a big Fed rate cut. We are back to J Powell easy money, and we got a really clear-cut rotation back into growth today. You can see that on my sector trends table indicator. All the defensive sectors, which had been hot of late, REITs, healthcare, staples, and utilities pulling back up front, along with volatility, yields, and the dollar index. That is pretty much the perfect setup in market color for a risk-on growth move, and it was green across the board. All the indices finishing high, led by mega cap tech, having an explosive move up there today, up over 3% as a group. Small caps outperforming the S&P once again, up over 2%, along with a lot of volume coming into advancing stocks. Breadth is really good. Also got the Dow Jones Industrial hitting a new all-time high. And stick with me today because we're going to go through some data and research. We're going to look at what are the key risks right in front of us, also going out in the medium term. I'm going to take a look at whether this is a fake out, similar to September 2007. Market rallied up for a few weeks after the Fed did a 50 basis point cut back then, only to top out and start one of the worst bear markets of our lifetimes. Or is this time different and we're just gone into a melt-up mode and the market's actually going to rip up into the election and beyond? Like I said, we'll take a look at some data along with the price action in key markets that are thrown off some clues to us. And so you got to hand it to J Powell. He is the ultimate wordsmith. With his new buzzword now, recalibrate. He is recalibrating interest rates lower, and the market is loving that. Hopefully this buzzword turns out to be right, unlike his last buzzword, transitory, when he was speaking about inflation back in 2021. Didn't quite turn out to be transitory. So for the here and now, the market and investors are loving that prospect that interest rates can be recalibrated down, the economy can keep growing, hoping the unemployment rate stays under 5%, corporate earnings hold up, and markets can keep on ripping to the moon. And you know they're going to keep the good times rolling for here and now. Like I've been saying all year, no way they're going to let the market crash before November. Anytime the VIX spikes, you're going to hear something from Janet Yellen indicating support for the market. And the thing is, we've got markets at all-time highs, and they're pressing it even further here. Her coming out today and saying the Fed cut's a positive sign for the economy, but policy is still restrictive. That is music to the stock market's ears. She's pretty much saying we need to get rates down a lot lower. 4.75% is way too high, even though long-term average rates are around 6 or 7%. And it's funny because just looking at economic projections from the Fed itself, the latest data we've got from this month, even though they've got GDP forecast at 2% this year and next year, if you go to their GDP Now website, their forecasting model, they've actually got it around 2.8% for this year. However, what's interesting is they see unemployment finishing the year at 4.4%. They see the same thing next year, and they actually see unemployment going down in 26, 27. That's not really suggesting a recession at all. And they just so happen to forecast inflation being smack bang on their target by 2026, 2.0. We'll keep that one in mind and come back to that projection in 2026. However, the most interesting stat out of all of this data is even though they think the economy is not going to go into a recession, unemployment rate is actually going to go down. They think they can drop the Fed funds rate to 2.9% in 2026. So that is the softest of soft landing. No wonder the market's ripping up here. But you want to know really why they're dropping rate? It's this chart right here. Debt profile in the United States. With when that debt is maturing down the bottom, 2024, 25, 26. Look how front-loaded the debt profile of the United States is. And again, you can thank Janet Yellen for that, who leads the decisions on what sort of treasuries to sell to the market. She absolutely front-loaded the states with debt during COVID, even when 10, 20-year bond yields were under 1%. It should be way more back here in the 2030s, 2040. Fact of the matter is, the United States government cannot afford rates to stay above 5%. And like I made a case for yesterday, in my opinion, they're happy to swap the risk of a recession for the risk of inflation and to get down the interest expense, which has been absolutely exploding higher. On track to spend over $1 trillion this year in servicing their debt. Or it could be like what billionaire hedge fund manager Kyle Bass said on X today. The Fed's large rate cut can be explained by only two scenarios. J Powell and his economists see the economy falling off a cliff, or it's a couple of weeks before early voting. A lot of people, probably Jay included, hoping we can repeat the mid-90s. Fed was able to orchestrate a soft landing. Pull back rates, economy didn't go into a recession, stock market still ripped up for another 5 years. With Alan Greenspan, hailed as one of the best Fed chiefs ever, and he went on a hiking cycle in 94, taking rates from 3% to 6% in February 95. The labour market did start cooling, with monthly jobless growth going down from 332,000 to 126,000. So he embarked on a few rate cuts and was able to get in front of a recession and stimulate the economy. Markets kept ripping up. 1996, he famously came out and said the market is irrationally exuberant. Nasdaq went on to triple in the next 4 years. And there's a historical look at previous easing cycles. Here we are here in the brown, got the years down below, 23, 24, 25, 26. So you can see on average, quite a lot of easing cycles take a year or so. They can start off quite steep, then flatten out. And that's kind of what the market's pricing in here in the dark blue as well. Thinking we're going to hit a terminal rate around 3% by 2026. However, that all depends on whether we get a recession or not. Like in 01 and 07, we get a recession, those rates will come down harder and quicker. Or like the mid-90s, they can stop early and kind of just let it plateau out. But there's no doubt that is all true. The Fed has significantly improved the odds of a soft landing. We are currently in that setup right now. Like I said, the economy's not fallen off a cliff. Jay Powell has gone big, started with a 0.5 point rate cut, and it's got a lot of people thinking we could repeat 07 and 01. However, keep in mind, no indicator works 100% of the time, not even the inverted bond yield curve, and that this time may be different, and the fact that he's, like Mohamed Al-Arand said yesterday, he may have just actually recalibrated what's normal for starting an easing cycle. He also may be playing a bit of catch-up after not cutting in July, which he copped a lot of criticism. He may have regretted that, just wants to get a good jump right off the line. Or does he see something that we don't all see, that he didn't really want to let on to yesterday? Seemed a little nervous to me, struggling to articulate his position, kind of saying like, yes, inflation's not where we want it, we're not declaring victory on inflation, and the economy's great, it's doing well, and then people are kind of like, well, why are you cutting 50 basis points then? If inflation's not great, but the economy is, and just looking at their data projections, they're not forecasting a recession. Like I said, there may be other ulterior motives at play here, but nonetheless, it does give the economy a better chance to reduce the possibility and the severity of a recession, and that's great news for the stock market. And like I said, it really lit up the AI tech trade again today, as you could think of growth stocks as being kind of like long duration assets, really sensitive to interest rates, trade at high valuations, and just like long dated bonds, they're going to have more volatility around the rate environment. And like Dan Ives said today, the Fed ripped the band-aid off and cut 50 basis points. We view it as very bullish backdrop for big tech and the AI revolution risk on trade into 25. The green light is back on for tech growth trade into year end and 25 in our view, with the Fed setting the stage in a dovish move. And I mean, it's hard to argue with the price action we're definitely getting out of this. Semi is the best performing sector today out of all the traditional sectors, up 4.3% on volume as well, potentially breaking this downtrend line. Tech sector as a whole, up almost 3% after it had been recently underperforming the market as a whole. And look at that, the defensive sectors, staples, utilities, and REITs actually fell today. Really clear risk-on growth rotation. And apart from those defensive sectors, pretty much everything else did well today. Got commodities moving up, international stocks, small caps, high-yield bond. When you significantly lower the cost of capital in the middle of an economic expansion, that's just more wind in the sails of this bull market. Or has the market already front-loaded the average return when the market is higher in an up year, which is 19%, which is exactly what the S&P 500 has returned so far this year, where it finished today. Looking back in history, an average down year is about 14%, and that's what gives the overall average return for the stock market around 8% a year. So a lot of people think that when it's going to be a good year, the market will be up 8, 9, 10%. Quite often, it's double that or more. Or is this going to be like 1995, when the S&P 500 finished up 33% on the back of a dovish Fed in an expanding economy, going into the internet boom? There's a look at asset performances 1 year after the Fed cuts rates. Welcome to pause your video player to take a further look. However, just looking back the last couple of times, the Fed cut rates. The 1 year performance after that got a bit of outperformance from bonds. No surprise there, interest rates coming down. The dollar was negative the last 2 times, actually positive in 01. However, key difference back then, the United States government balance sheet was far more healthy than what it is now. The last couple of times we got a rally in gold. Interest rates coming down has been a positive for gold, and a little bit mixed for oil. Down, up, down, up. And of course, it can cause high yield spreads to blow out as well, especially in a recession. And so we're getting some of the old favorites catch a bid here today. One of the most popular stocks coming back, Tesla, something we've been talking about in anticipation of their robo-taxi unveiling next month. The ongoing bull thesis around full self-driving, FSD, and why Tesla, like a lot of clean energy stocks, are ripping up here is because they're high-ticket purchases. Most consumers finance them, and now that financing just got a whole lot easier, or it's about to, just around the corner, and likely to keep improving over the next year or so. Like the Fed's telling us, they think the economy's going to hold up, unemployment's going to come down, and they still plan to keep dropping rates. They want to get rates down to a 2 handle. Imagine they can pull that off. Could be looking at the S&P at 10,000 if we go into a real melt-up over the next couple of years. And who knows, that could take Tesla up to a market cap past its old record high, just over $1 trillion. Who knows, maybe 2 or 3 trillion. Certainly looking pretty good there on the chart, up 7% today on volume, getting back towards yearly highs. And look at that with Apple, biggest stock in the market. Now just under 3.5 trillion market cap. Investors really betting the new iPhone 16 is going to drive a new upgrade cycle. Microsoft holding up there as well, along with Amazon and Alphabet Google, just managing to reclaim its 50-day. But actually doing the best, Meta found a brand new all-time high today, $559 a share, 1.4 trillion market cap. And just looking at my fundamental indicators, it's got fair value at $438, which is implying a 27% premium, which again for a company like Meta and how dominant it is, along with the potential for it to lead in virtual reality in the metaverse, I'd say it well and truly deserves that 27% premium. So I'd call it at fair value right here. And just looking at my fundamental trends chart, just about as good looking as it gets. It's been in a well-defined clear uptrend since January last year. My trend candles indicator went green on the weekly chart. Revenue, cash flow, EPS estimates, all beautifully trending upwards, and my earnings yield premium pretty much sitting at flat, which is amazing. That means the current earnings yield on Meta is equivalent to that of short-term government bonds, and I'm pretty sure Meta is going to keep growing their income faster than short-term bonds here. And the price has pretty much been consolidating all year, so we may have just broken out of a months-long consolidation and base, and this trend could well and truly continue on. We just saw the beaten down and widely hated Chinese stock market also catch a bid today. What the US government and Federal Reserve does not only impacts the American economy, it impacts the global economy. A lot of global companies borrow and transact in US dollars, sell to the US market, and a lot of governments and central banks around the world can follow the US's lead as well. Not to mention the US has the biggest impact on global geopolitics. So what Jay did yesterday is like throwing a big rock, in fact a rock twice the size we thought he was going to throw, into a big lake. Now we've got the ripple effects coming out all around the world. And we can see that in the price action of the Chinese large cap ETF traded in New York under ticker FXI, ripping up over 3.5% today, multi-month highs on above average volume, with Chinese internet stocks ETF KWEB also doing really well, up almost 4.5%, and we may have just broken out above a key downtrend line. Chinese stocks starting to look good. See that with Alibaba, which has been on sale for quite a while now. My regular viewers will know I was banging on about how good value it was in the high 60s. Here we are today, $88, also pressing up on good volume. So that's the question, isn't it? A continued soft landing like the mid-90s, or a recession like 2007? Or what about another scenario? No soft landing, no recession, but a resurgence in inflation? Or is it like William Dudley says, Fed is more worried about the labor market than Powell led on? Of course, he's not going to come out right in front of the election, start ringing alarm bells. It's not going to please his masters, is it? Washington leaders know very well the Fed's supposed to be independent and free from influence. However, that didn't stop Elizabeth Warren sending a demanding letter to him saying they expect him to cut 75 basis points. So they pretty much got 50. However, someone like economist David Rosenberg says the Fed's 50 basis point rate cut won't do anything to stop a recession. He's concerned about weakness in housing, commercial construction, and the industrial sector. Going on to say, as was the case in 07, the cycle was turning. All of a sudden, the data underwent significant revisions. And it's true. The economy, the jobs market, just like the stock market, can make swift and sharp turns. You could kind of think of Jay's 50 basis point cut as maybe a bit of an insurance policy on that. Even the uber bullish Tom Lee says investors should be hesitant to dive into stocks after the rate cut, with election uncertainty looming. Still believes small caps are the best place to be. Still believes in this bull market, but just says the next couple of months could get a bit dicey, which should come as no surprise. However, as always, we pay attention to price action first, and we're getting a pretty clean breakout today. Maybe we don't get a down month on the S&P for September, which is historically the worst month of the year. Maybe we don't get another VIX spike in October for the election, although that could still be unlikely given the build-up we've seen this year. Even got billionaire Ray Dalio calling the upcoming US election the most consequential of his lifetime, adding that he thinks the country needs a strong leader of the middle and the US should aim for broad-based prosperity. And the upcoming elections highlight challenges to society's ability to function smoothly. He thinks the US could be on a path to civil war, not to mention geopolitics, the worst they've ever been. He also mentions inflation, high cost of living, and that this election is going to be a big one. Not all stocks participating in the rally today. We've got key transport stock FedEx tanking after hours as I speak on the back of their earnings. Coming in below expectation, 360 versus the street 475. Quite a big miss there. Also bringing down their forward guidance, citing lower demand for premium services, especially among industrial customers. CEO emphasizing ongoing efforts to improve efficiency and reduce costs, and not even an additional $1.5 billion share buyback program could help them out today. Analysts downgrading them, and so is the market after hours as I speak, just going down to the 5-minute chart, currently off 11%. However, just zooming out, they have been having a pretty good year, so we're currently trading around here, 267. Still up on the year, but nonetheless, in a healthy bull market, just like Charles Dow told us over 100 years ago, you want to see the industrials and transports breaking out to 52-week highs to confirm it. And speaking of that, there's the weekly chart of the Dow Jones Industrials, which is breaking out to a 52-week high, and there's the Dow Jones Transport Index, which is not breaking out to a 52-week high, has been consolidating since 2021. However, it is shaping up and very well could break out, and that's the Dow Theory confirmation signal. And it wasn't just the Fed, this is central bank week. We just heard from the Bank of England actually hold on rate, opting for a bit more of a cautious approach than the Fed, leaving their key rate unchanged at 5%, wanting to emphasize a gradual approach to cutting rates to ensure low inflation. We also just heard from Norway, Taiwan, Turkey, who also left their rates unchanged. Brazil just actually increased their rates due to revived inflation. And just like Jamie Powell, some random guy on X said today, the UK now has a higher interest rate than the USA with a lower inflation rate and 1/3 the rate of economic growth, which I thought was a good point. And look at that, British pound futures also catching a bid, trading up, breaking out against the dollar. But the big one a bit later on in today's Asian session is the Bank of Japan meeting, in which they're widely expected to keep their policy rate at 0.25% after they just increased them from 0.1 in July, at the same time indicating to the market they're ready to hike further, whilst the Fed just told us they're ready to cut rates, causing a massive unwind in the yen carry trade. If they were to come out and surprise markets today with a hike or even some hawkish language indicating to the market they're about to hike, that could set off a bit of a rug pull. There's a look at dollar yen. It's been under pressure of late, actually trading lower than where we were in the last rug pull, 5th of August. Still underneath its 50, so the risk is still there for another yen carry trade unwind. Moving on to economic data, and we were thinking yesterday since J cut 50, maybe there's some really bad jobs data just around the corner. Didn't appear to be the case today. Jobless claims actually fell to the lowest level since May. Only 219,000 Americans filing for unemployment benefits versus the forecast of 229,000. And so that's another good print for the jobs market, just like we saw the last unemployment rate come down from 4.3 to 4.2. That is, of course, if we are to believe the numbers that have been fed to us. Nonetheless, got a little tick up in bond yields today. Like I said, may have been a sell the rumor, buy the news event. With the 2-year pretty flat, so Janet Yellen wants to keep it that way. However, the 10-year catching a bid, 371. But look at that again, the spread of inflation expectation also catching a pretty good bid today. I think that's the market sending us a clear signal, repricing the risk for inflation to come back, which of course won't show up until next year's numbers. Black gold also caught a bid today. Crude oil popping up. Maybe it too getting excited about the prospect of a soft land, continued economic expansion driving energy demand. There's a look at crude today, trading a bit above $71 a barrel, still below its 50 though. Once again, I'm hard pressed to find articles about gold across mainstream financial media. Did find one on Newsbite saying India's gold imports surged to a record 10 billion in August. Been seeing a lot of news like this lately. Chinese and Russians buying gold like crazy. Apparently the Saudis secretly trying to buy gold from Switzerland. The rise of BRICS, in which they seem to be making a gold a key part of their reserves. Maybe a bit of a threat to some people out there. Here's an interesting graphic for you today. Countries with the largest gold reserves. With a total 59,000 metric tons in the world. Australia at the front, 12,000, just ahead of Russia. Also South Africa, China, States and Canada, along with Brazil and Peru. And Indonesia, having a lot of the shiny stuff in their ground as well. And there's a look at gold. After we did that yesterday reversal in markets to be doing a bit of a textbook move that you would expect with a big rate cut. However, unless we go into a real melt up mode, everyone piling on it as an obvious trade now, could still be setting up for a shakeout as the fundamentals have improved, but sometimes when things become too obvious, they can just go the other way. And like I said, that's what causes a shakeout. Also interesting to note, there's just been a big structural change in the US stock market. Get ready to see stock prices trade in half-penny. Regulators vote to reduce minimum price increments for some stocks, and the SEC's just voted to approve that, in which they say will help lower costs for investors by narrowing bid-ask spreads, the difference between buying and selling price. And so that'll definitely help lower price stocks, especially if you're looking, say for example, at a $1 stock, the bid's 101, the offer's 102, you're paying 1% spread if you're not using limit orders and adding liquidity. So that definitely should help. However, the rule's not set to take effect until November next year. And so I applaud the SEC for that, because that will benefit investors more actually at the price of market makers who will be earning narrower spread. And speaking of spreads, that brings me to my next point. And I heard a few people complain across social media earlier this morning. We had markets gap up huge, pretty much traded flat and down yesterday in the regular session, just like they did today. Just looking at the 5-minute chart there of SPY, pretty much up and down, flat, just kind of like what we did yesterday. A lot of shakeouts and spikes, but then look at the overnight session, rip right up. And so I heard a lot of people say oh, the market's rigged. Flat yesterday is flat today, gapped overnight. How are we supposed to capture those gains? Well, first of all, the market's not rigged now. It's been like this for decades. Looking back at research, pretty much all of the market's gains come overnight. And we've seen that in multiple research, like this one here. Looking back since 93, if you just held S&P 500 during regular hours, you missed out on all the overnight gains, you'd actually be down a little bit. And so there's a reason for that. And you'll find this in the market. A lot of premium and returns come from taking a risk. And so that's the liquidity premium, since you can't really trade overnight. And I know there's post-market, pre-market, up to 8 p.m. starting at 4 a.m. However, the market is dark in between those times. And even in those times, there's a lot of liquidity. There's a lot of news out, earnings, stocks can move, which also give a return premium for taking on that volatility risk. And this is another reason why day trading is so hard, especially in modern days. That's what's changed. And I wouldn't call it rigged, although there is plenty of predatory front-running algos out there. It's more of a case of whatever pattern you think you see, or whatever edge you think you've got, by the time you see it, it's already gone. You'll be beat by the algos. And I'm not saying day trading is not possible. There's definitely some people out there that can pull it off. A lot of them just short penny stocks, pump and dump schemes. A lot of them eventually blow up because they short a small stock, then it rips up 1,000%. So there is for sure people out there that can day trade. That's mostly, like I said, small penny stocks. However, you just look at the stats, something like 98% of people that day trade actually lose money. And so anyone pushing day trading to you, they're just encouraging you to gamble. In my opinion, you're better off going to the casino and playing blackjack, because at least in blackjack, the house has only got 2% odds. But if you're day trading and you're just constantly hitting the offer and bid, constantly paying that spread, commission, it's pretty much impossible to win in the long term. And sure, you can use limit orders. However, what you'll find with limit orders is if you get filled, the market's about to go against you, because the algos can read the order flow better than you. They got their servers co-located next to the exchange, millisecond trade times, all the best data resources. And to think that you can actually beat Citadel and all these other high-frequency trading firms, like I said, it's just near impossible. That's why you'll never see me promote day trading to you. Never have, never will. Like I said, you're better off going to the casino. At least you'll get free drinks. And in my opinion, the real edge for small investors, like you and I, is investing in smaller stocks that these larger institutions are not even allowed to touch. And I'm not talking about garbage junk stocks either, like penny stock. Kind of think of them like the bottom of the ocean, really muddy and murky area. I'm talking about market cap from 200 million up to about 5 billion, especially under a billion or two. A lot of these institutions, they're not allowed to touch those stocks. There's just simply not enough liquidity. And further to that point, investing in small stocks and holding them for at least a month or two. If your average holding time is less than a month or less than a week, you're going to have a really hard time trying to beat the algos that dominate that space. However, if you invest in a good small stock and your average holding time is even 6 months, a year or longer, well, in my opinion, that's the real edge for us small investors. And by small, I'm talking about anything less than 10 million. And what I said about day trading also goes for Forex, also known as FX or CFDs, which are popular outside of America. Again, anyone promoting that stuff to you is just encouraging you to gamble, because they are the modern day bucket shop. Pretty much all of them, you're trading against a broker. You're not even trading on a real exchange. And just like sports betting against a bookie, if you start winning too much from them, they're going to mess with your account, if not just shut it down. Just like if you're counting cards in a casino, they'll ask you to leave. They'll cite you with trespassing if you come back. So in my opinion, you want to stay far away from day trading, far away from CFDs, far away from FX. Anyone promoting that stuff is just getting a kickback from the broker that is shilling for a bucket shop. And again, you're better off going to the casino. At least you'll get free drink. Anyway, just getting back into the market. There's the SPY. Bit of a spinning doji there today, breaking out. Also getting good signs on Brett. Volatility coming down, 16. Still a little bit of volatility risk premium. And you want to know what's really giving it away is high yield bond. Pretty much ripping up all year, telling us everything was going to be okay. There's a look at the dollar, looking pretty heavy at the bottom of its support zone. See whether that can hold. And Bitcoin also trading higher today, along with silver pressing up above 31 an ounce. And uranium just getting back above its 50 as well. But like I said, the theme today was that risk-on growth rotation. There's the growth sectors versus defensive sectors, up 2.5% today. Same with high beta versus low volatility. This is risk coming back into the market. And look at that, it's kind of like the market saw that 50 basis points coming. Good news, it's happening while small caps are holding up against large caps, and there's discretionary stocks returning against staples. But what's most interesting to me today is inflation expectation, making a strong move higher as well. So back to the question, is this a fake out or a melt up? And of course, none of us know 100% for sure. We could be on the verge of another Bank of Japan rug pull. Anything can happen. However, just looking at that language coming out from Janet Yellen and Jay Powell yesterday, this is really loose monetary conditions at all-time highs. Corporate earnings expectations, all-time highs. Economy not falling apart as of yet. I'd say the risks are to the upside, and we very well could go into a melt up if everything starts looking perfect and everybody piles on. And just certainly looking at market color today, Like I said, about as bullish as you can get. Rotation out of defensives into growth. Volatility, yields, and the dollar, all negative. That's really bullish for stocks. However, as usual, it's always a dynamic situation. Things can change from day to day, and we'll always follow the tape and price action first and foremost. But all-time highs is the most bullish thing you can get. There's no overhead resistance. It is blue skies, and the market pretty much played out like everyone thought it should have yesterday. Just did a really good late afternoon kind of fake out. Looking like it was bearish, but indeed we got the big gap up this morning and it held. Thanks very much for sticking with Click Capital, and I look forward to breaking it all down again for you tomorrow. Cheers.